In a world where market volatility is the only certainty, protecting your investments isn't just an option, it's a necessity. But what if there was a way to shield your portfolio, even as the financial storms rage? Welcome to the haven of defensive ETFs, the unsung heroes when markets crash. In this video, we're diving deep into the best defensive ETFs to buy in a market crash. From the solid foundations that withstand economic earthquakes to the strategies that savvy investors use to navigate through the tumultuous tides, we've got you covered. Let's jump into things now. The Invesco Food and Beverage ETF could be a good defensive investment during a market downturn for several reasons. First, it focuses on the consumer staples sector, which includes companies that produce and distribute essential goods like food and beverages. These products tend to have consistent demand regardless of economic conditions, making the companies within this sector less prone to the dramatic swings that can hurt other industries during downturns. Additionally, many of the companies in the Invesco Food and Beverage ETF are large, well-established brands with strong market positions. These companies often have robust balance sheets and the ability to weather economic storms better than smaller, more volatile businesses. It's important to note that even defensive ETFs are not immune to market downturns, but their focus on essential goods and established companies can provide some insulation compared to ETFs that track broader markets or more cyclical sectors. The First Trust Consumer Staples AlphaDEX fund is another strong contender as a defensive investment during a market crash. Similar to the Invesco Food and Beverage ETF, it focuses on the consumer staples sector, providing exposure to companies that produce essential goods like household products, food, and beverages. These goods experience consistent demand even during economic downturns, giving the sector inherent resilience. What sets the First Trust Consumer Staples AlphaDEX fund apart is its AlphaDEX methodology. This methodology screens stocks not only for typical value and growth factors, but also emphasizes those with positive momentum. This means that the fund is likely to include companies within the consumer staples sector that are performing well even in a difficult market environment. This approach can help mitigate potential losses when compared to broader consumer staples ETFs. Before we get to the rest of the investments, I want to remind you to click the link in the description to check out Insider Newsletter. I've reviewed over 100 stock picking services, and Insider Newsletter gets the best returns, and for a limited time, it's only $1 to try. ProShares Ultra Consumer Goods is an interesting case. Unlike the previous examples, this ETF is a leveraged fund that seeks twice the daily returns of the S&P Consumer Goods Select Sector Index. This means it has the potential to outperform the broader consumer goods market in good times, but also carries added risk. While it still focuses on the consumer goods sector, offering exposure to companies that produce essential items that generally experience less dramatic declines during downturns, the 2x leverage is where the difference lies. This leverage amplifies gains during market upswings, and it also works in reverse during downturns. That means ProShares Ultra Consumer Goods may see a less severe decline compared to a standard consumer goods ETF if the downturn is relatively mild. However, it's crucial to note that the increased risk of this ETF is significant. Severe market crashes would magnify the losses for investors in ProShares Ultra Consumer Goods. It might be a suitable choice for short-term, risk-tolerant positions within a portfolio, but likely less ideal as a core long-term defensive holding compared to the other ETFs we've discussed. The iShares US Consumer Staples ETF is a classic choice for defensive investing during market downturns because it tightly focuses on the US consumer staples sector. This sector includes companies involved in the production and distribution of essential goods like food, beverages, household products, and personal care items. These goods are always in demand, making the sector less susceptible to the volatility experienced by other industries during economic downturns. Additionally, the iShares US Consumer Staples ETF typically holds a significant portion of its assets in large, well-established companies with strong brand recognition. These companies often boast robust balance sheets and have a proven track record of weathering economic storms. It's worth looking back at the historical performance of this ETF during previous market downturns. Consumer staples ETFs have generally shown less severe declines compared to broader market ETFs, demonstrating their defensive nature. Overall, the iShares US Consumer Staples ETF provides a solid, diversified way to gain exposure to a relatively stable sector, making it a smart consideration for a defensive segment of your portfolio. The Vanguard Total Stock Market Index Fund is a bit of a mixed bag when it comes to being considered a defensive ETF in a market downturn. Firstly, it's important to understand that it offers incredibly broad exposure to the entire US stock market. This means it includes companies from all sectors, including those that are highly sensitive to economic cycles. When a market crash occurs, it's likely that this ETF will experience declines along with the broader market. However, there are some mitigating factors. The low-cost nature of index funds like the Vanguard Total Stock Market Index Fund makes them attractive for long-term investors. The idea is to ride out market downturns and benefit from potential recoveries. Additionally, the fund's massive diversification means that even if some sectors get hit hard, others might act as a buffer. Ultimately, whether the Vanguard Total Stock Market Index Fund is a good defensive investment during a market downturn depends on your perspective and investing time horizon. It's less defensively positioned than ETFs focused purely on consumer staples or utilities, but for long-term investors committed to weathering market storms, it remains a popular and broadly diversified option. And if you really want to make money with the stock market, make sure to click the link in the description to check out Insider Newsletter. I've reviewed hundreds of stock-picking newsletters, and Insider Newsletter performs the best by far. On top of this, it's only $1 to try. So again, click the link in the description to check out this newsletter.